Have you ever looked at the badge on the front of a heavy truck and assumed you knew who actually owned the company that built it? Because for most people, a Scania is a Scania, a Swedish truck built by Swedish engineers, running under a Swedish name that has meant durability and long-haul reliability since before most trucking companies on the road today even existed. And that perception is not wrong. Exactly, but it is incomplete in a way that matters if you actually want to understand how the modern truck manufacturing industry works. Because Scania has not been an independent Swedish company for a long time, it has been for the better part of 2 decades, a fully owned subsidiary of one of the largest industrial conglomerates on the planet. And the story of how that happened, the slow accumulation of shares, the boardroom fights, the hostile bid, the rival German manufacturer caught in the middle of it, and the reorganization that followed, is one of the most consequential and least understood stories in the history of commercial vehicle manufacturing. Today we are getting into that story. Why Volkswagen Group wanted a truck maker in the first place, how the acquisition of Scania actually happened, why it took the better part of 15 years to complete, what it meant for MAN, Scania's biggest rival and eventual sister company, and what the whole arrangement tells us about how the economics of building heavy trucks actually work behind the badge on the grille. Stick around, because once you understand this, you will never look at a Scania or a MAN truck on the highway quite the same way again. Hey everyone, Travis Walker here, Titan Haulers coming at you from the shop in Amarillo. Now, I have spent 20 years around diesel engines and heavy equipment, and one thing that took me a long time to fully appreciate is that the badge on the front of a truck tells you almost nothing about who actually owns the company, who engineers the components underneath it, and who is making the decisions about what gets built 5 years from now. Scania is one of the best examples of that in the entire industry. Independent Swedish engineering company in the public imagination. Corporate subsidiary of a German industrial giant in the actual paperwork. Tonight, we are walking through exactly how that happened and why it matters more than most people realize. Let's get into it. To understand why Volkswagen Group spent the better part of 2 decades and billions of dollars pursuing Scania, you have to understand what Scania actually was before any of this started. Scania traces its roots back to 1891, originally as a manufacturer of railway wagons before shifting into vehicle production in the early 20th century. By the second half of the 20th century, the company had built a reputation as one of the most respected heavy truck manufacturers in the world, known specifically for a modular engineering philosophy that allowed a relatively small number of core components, engines, gearboxes, axles, cab structures, to be combined and configured into an enormous range of finished vehicles. This modular approach kept manufacturing costs down while still letting Scania offer highly customized trucks to customers with very different operating needs, from long-haul highway hauling to heavy construction and mining applications. Scania also built a strong position in heavy buses and industrial and marine engines, giving the company multiple revenue streams beyond its core truck business. By the late 20th century, Scania was consistently ranked among the most profitable truck manufacturers in the world on a per-vehicle basis, a reputation built on premium pricing, strong residual values, and a customer base of professional operators who valued total cost of ownership over sticker price. This is exactly the kind of company that a larger industrial group looking to enter or expand in the heavy commercial vehicle market would want. Not a struggling manufacturer that needed to be rescued and rebuilt, but a well-run, profitable, technically respected company that would be difficult and expensive to replicate from scratch. And that is precisely the position Volkswagen Group found itself reasoning through in the final years of the 20th century. Volkswagen Group, at the turn of the millennium, was already one of the largest automotive manufacturers in the world, built around its core Volkswagen passenger car brand along with Audi, and a series of acquisitions through the 1990s that had brought Seat, Skoda, Bentley, Bugatti, and Lamborghini under the same corporate umbrella. What Volkswagen Group did not have at that point was a serious position in the heavy commercial vehicle sector, the market for the large trucks that move freight across highways and the buses that move passengers around cities. This mattered for a specific strategic reason. The passenger car business and the heavy truck business are different markets with different customers, different competitive dynamics, and importantly, different economic cycles. Passenger vehicle sales are heavily influenced by consumer confidence, interest rates on auto loans, and fuel prices. Heavy truck sales are driven by freight volumes, industrial production, and infrastructure investment, which do not always move in the same direction or on the same timeline as consumer vehicle demand. A large industrial group with exposure to both markets has a more diversified revenue base than one exposed to only one of them, which is a meaningful consideration for a company managing billions of dollars in capital investment across multiple vehicle platforms and manufacturing facilities. There was also a scale argument specific to heavy trucks. Developing a modern diesel engine platform, an emissions control system capable of meeting increasingly strict regulatory standards, and a driveline architecture that can be shared across multiple vehicle types is extraordinarily expensive. The truck manufacturers that survive and remain profitable in this industry are generally the ones that can spread those development costs across the largest possible production volume. A group that controlled multiple truck brands, each with their own customer base and market position, but sharing core engineering underneath, could achieve exactly that kind of scale without having to make every customer buy the same badge. Volkswagen Group already had a foothold in commercial vehicles through its ownership of MAN, the German truck and bus manufacturer, and had been building a position in the sector for years. Scania represented the next, and considerably more ambitious, step in that strategy. Not a company that needed rescuing, but a highly profitable, technically excellent manufacturer that would give Volkswagen Group a second major truck brand, with genuine engineering depth and a strong position in markets where MAN was comparatively weaker. Volkswagen Group's pursuit of Scania did not begin with a takeover bid. It began, as these things often do in large industrial acquisitions, with the quiet accumulation of shares over an extended period, building a position large enough to have genuine influence over the company's direction before any formal move was made. The relationship between Volkswagen and Scania actually predates any ownership stake, going back to earlier cooperation agreements between the two companies on component sharing and joint development projects. This kind of technical cooperation between manufacturers is common in the industry, since sharing certain engineering costs across companies that are not direct competitors in every segment can benefit both parties without either one giving up its independence. But cooperation agreements have a way of evolving over time into something closer to genuine corporate interest, particularly when the companies involved are exploring how deeply their engineering and manufacturing operations could realistically be integrated. Volkswagen Group began building a direct ownership stake in Scania around the turn of the millennium, acquiring shares gradually rather than launching an immediate takeover attempt. This kind of gradual accumulation is a deliberate strategy in corporate acquisitions of publicly traded companies, particularly in jurisdictions with dual-class share structures, because it allows an acquiring company to build genuine influence and negotiating leverage without necessarily triggering the regulatory thresholds and shareholder reactions that come with an outright hostile bid straight out of the gate. Scania's ownership structure at the time included a dual-class share system with A shares carrying stronger voting rights than B shares, a structure that is common in Swedish and broader Nordic corporate governance, and that gave certain long-term shareholders, including Scania's own founding family-linked interests and other Swedish industrial holding companies, outsized influence over the company's direction relative to their pure economic ownership stake. This structure meant that simply accumulating a majority of the total shares outstanding would not necessarily translate into control, since a hostile acquirer also needed to either win over or outmaneuver the holders of the high-vote A shares. The story becomes considerably more complicated and considerably more interesting once you bring MAN into the picture, because for a period of time, MAN itself attempted to acquire Scania directly, creating a genuine three-way corporate contest over the future of one of Europe's most respected truck manufacturers. MAN, the German truck and bus manufacturer, launched its own attempt to acquire Scania in 2006, seeking to combine the two companies into a single larger European truck manufacturing group that MAN's management believed would be better positioned to compete against the largest global truck manufacturers. Scania's board and management resisted this approach, arguing that MAN's offer significantly undervalued the company, and that a combination on the terms MAN was proposing was not in the interest of Scania's shareholders or its long-term technical independence. What made this situation genuinely unusual is that Volkswagen Group at the time held significant ownership stakes in both companies simultaneously. Volkswagen was already a substantial shareholder in Scania through its gradual share accumulation, and Volkswagen also held a meaningful stake in MAN. This put Volkswagen in the position of effectively holding influence over both sides of a contested takeover battle between two companies it partly owned, which created obvious complications since a merger between MAN and Scania on terms that Scania's management and other shareholders considered unfavorable was not necessarily in Volkswagen's own long-term interest as a shareholder in the company being undervalued. MAN's hostile takeover attempt of Scania ultimately failed in 2006, unable to secure sufficient shareholder support given the resistance from Scania's board and the complicated cross-shareholding dynamics involving Volkswagen. The failure of that attempt did not end the broader consolidation story. It simply reset the terms on which any future combination would eventually happen, and it left Volkswagen Group as the party with the clearest path to eventually bringing both companies under a single controlling structure, given its existing stakes in each. Following the failed MAN bid, Volkswagen Group continued to build its position in Scania over subsequent years, gradually increasing its ownership stake well beyond what would have been required for simple influence and toward what would eventually be needed for outright control. This process extended over the better part of a decade, reflecting both the deliberate pace at which Volkswagen chose to pursue the acquisition and the genuine complexity of assembling sufficient voting control given Scania's dual-class share structure and the presence of other significant shareholders who were not necessarily eager sellers. Volkswagen's stake in Scania grew steadily through continued share purchases, eventually reaching a position where the company held both a majority of the total shares outstanding and critically sufficient voting control given the concentration of A shares it had accumulated. By 2014, Volkswagen Group moved to acquire full ownership of Scania, launching an offer to buy out the remaining minority shareholders and take the company fully private under Volkswagen Group's ownership structure. This step, often referred to as a squeeze-out in corporate finance terminology, allows a majority shareholder that has crossed certain ownership thresholds to compel remaining minority shareholders to sell their shares at a fair price determined through the offer process, consolidating full ownership rather than continuing to operate the company as a publicly traded entity with minority shareholders who could complicate strategic decision-making. The full acquisition was completed in 2014, and Scania was delisted from the Stockholm Stock Exchange, ending more than a century of public trading in the company's shares and formally bringing Scania fully under Volkswagen Group's ownership umbrella as a wholly owned subsidiary. What had started with quiet share accumulation at the turn of the millennium survived a hostile takeover attempt by a sister company within the same broader corporate group, and continued through more than a decade of gradual position building, finally concluded with Scania as a fully integrated part of Volkswagen Group's industrial holdings. The acquisition of full ownership was not the end of the story. It was, in an important sense, the beginning of the next phase, because owning Scania and MAN separately as distinct subsidiaries reporting individually into Volkswagen Group's broader corporate structure was never the end state Volkswagen's strategy was actually working toward. In the years following the full acquisition of Scania, Volkswagen Group moved to consolidate its commercial vehicle holdings. MAN, Scania, and the Volkswagen Caminhões e-Ônibus truck and bus operation in Brazil under a single dedicated commercial vehicle holding structure. This entity was established as Volkswagen Truck and Bus, later rebranded as TRATON, reflecting Volkswagen Group's broader strategic intent to create a genuinely integrated commercial vehicle group that could share engineering, platforms, and components across its constituent brands while preserving each brand's distinct market identity and customer relationships. TRATON was subsequently taken public through its own stock market listing in 2019, while Volkswagen Group retained a majority controlling stake in the new entity. This structure allowed Volkswagen Group to raise capital and give TRATON its own independent equity currency and reporting structure as a commercial vehicle group in its own right, while Volkswagen Group maintained strategic control over the overall direction of its truck and bus holdings. The logic behind consolidating MAN and Scania under a shared holding structure rather than continuing to run them as entirely separate operations mirrors exactly the scale argument that motivated the original pursuit of Scania in the first place. Shared component development, shared platform engineering for elements like transmissions, axles, and increasingly electric drivetrains, and shared purchasing power with suppliers all become more achievable when two large truck manufacturers are operating under coordinated strategic direction rather than as fully independent competitors, even while each brand continues to be marketed, sold, and serviced as a distinct product line with its own dealer network and its own engineering identity in the areas that matter most to customers. Here's where the story gets particularly relevant to anyone who actually operates or maintains these trucks for a living, because one of the most consistent findings across the entire Volkswagen Group commercial vehicle consolidation has been the deliberate decision to keep MAN and Scania operating as genuinely distinct engineering and manufacturing organizations rather than collapsing them into a single shared platform with different badges slapped on top. This is a meaningfully different approach than what happens in some other large automotive group consolidations, where shared platforms and heavily rebadged vehicles across brands are common practice in the passenger car segment. In the heavy truck world, professional buyers are far more sensitive to the specific engineering characteristics of the vehicle they are purchasing, since a truck is a working capital asset that needs to deliver a specific total cost of ownership over hundreds of thousands of kilometers, not a consumer purchase driven primarily by styling and brand perception. Scania has continued to operate its own dedicated engineering and manufacturing operations centered on its historic facilities in Södertälje, Sweden, maintaining the modular engineering philosophy that has defined the brand for generations. MAN has continued to operate its own distinct engineering and manufacturing base in Germany with its own engine programs, cab designs, and driveline architecture. Both brands continue to compete against each other in the market in certain segments, which might seem counterintuitive for two companies under the same ultimate ownership, but reflects a recognition within TRATON's broader strategy that the value of both brands depends substantially on their continued technical distinctness and their separate reputations among professional fleet operators. What has been shared increasingly are the less visible elements of vehicle development that do not directly define the customer-facing character of either brand, certain component sourcing arrangements, joint investment in emerging technology like electric and hydrogen powertrain development, shared research into autonomous driving systems for commercial applications, and coordinated approach to the enormous capital requirements involved in meeting increasingly strict global emissions regulations. This is exactly the kind of scale benefit that motivated Volkswagen's original strategic thinking, achieved without undermining the specific engineering identity that gives each brand its value in the marketplace. For anyone actually operating, maintaining, or purchasing these vehicles, understanding this ownership structure has practical relevance beyond simply being an interesting piece of corporate history. A Scania purchase today is still, in every meaningful engineering sense, a Scania. The company's modular design philosophy, its engine programs, its cab architecture, and its overall approach to building trucks continues to be developed by Scania's own engineering organization, informed by the same institutional knowledge and design priorities that have defined the brand for more than a century. The fact that Scania's ultimate parent company is Volkswagen Group, operating through the TRATON holding structure, has not meant a wholesale replacement of Scania engineering with shared Volkswagen Group components, in the way that has happened with certain shared platforms in the passenger car world. The same is true of MAN, which continues to develop and manufacture its own distinct product line, even as it shares an ultimate parent company with Scania, and through Volkswagen Group's broader industrial holdings, an extremely distant corporate relationship with Volkswagen's passenger car business, Audi, Porsche, and the rest of the group's automotive brands. What has changed and what does matter for the long-term trajectory of both brands is the scale of capital available for research and development in areas like electrification and alternative powertrains, where the enormous cost of developing entirely new drivetrain technology benefits substantially from being spread across a larger combined engineering and manufacturing base than either MAN or Scania could support entirely on its own as a fully independent company. Both brands' transition toward electric and alternative fuel-heavy trucks has been meaningfully accelerated by access to TRATON's combined engineering resources and Volkswagen Group's broader capital position compared to what either company would likely have been able to invest independently. The Volkswagen Group and Scania story is not an isolated case. It reflects a broader consolidation pattern that has reshaped the global heavy truck manufacturing industry over the past several decades. As the enormous capital requirements of modern engine development, emissions compliance, and increasingly electrification have made it progressively more difficult for smaller, fully independent truck manufacturers to compete on a global basis. Daimler, through its Daimler Truck Operations, controls Freightliner in North America alongside Mercedes-Benz trucks in Europe and other regional brands, following a similar logic of combining distinct regional brands under shared engineering resources while preserving separate market identities. Volvo Group similarly controls Mack Trucks in North America alongside the core Volvo Trucks brand in Europe, along with Renault Trucks, again preserving distinct brand identities, while sharing underlying engineering resources where it makes economic sense to do so. This pattern of large parent groups controlling multiple distinct truck brands, each maintaining its own market identity and engineering character, while benefiting from shared scale in the most capital-intensive areas of development, has become the dominant structure across the global heavy truck industry. The era of large numbers of fully independent standalone truck manufacturers competing purely on their own individual scale has largely given way to this consolidated structure, driven by the same fundamental economics that motivated Volkswagen Group's long pursuit of Scania in the first place. Here's the bigger point that the Volkswagen and Scania story illustrates, and it is a point worth sitting with if you spend any amount of time around heavy trucks professionally. The badge on the front of a truck tells you about the engineering philosophy, the brand heritage, and the specific product characteristics that company has built its reputation on. It does not necessarily tell you who owns the company, who controls its long-term capital allocation decisions, or how deeply integrated its parts sourcing and platform development might be with what looks, on the surface, like an entirely separate competitor. Understanding these ownership structures matters for anyone making serious purchasing decisions about fleet equipment, because the long-term viability of a truck brand's parts supply, service network, and continued engineering investment depends substantially on the financial strength and strategic priorities of its ultimate parent company, not just the reputation of the brand name on the vehicle itself. A brand backed by a well-capitalized parent group with a clear long-term strategic commitment to that brand's continued independent engineering identity is a fundamentally different proposition than a brand operating as a truly standalone company exposed entirely to its own individual market fortunes. The Scania acquisition took the better part of 2 decades to complete, survived a hostile takeover attempt by a sister company within the same broader corporate family, and ultimately produced a structure that has allowed one of the world's most respected truck manufacturers to continue building genuinely distinct, technically excellent vehicles, while gaining access to the scale of capital investment that modern truck development increasingly requires. That is a meaningfully different outcome than the badge engineering consolidation that critics of large automotive conglomerates sometimes fear, and it reflects a deliberate strategic choice on Volkswagen Group's part to preserve what actually made Scania valuable in the first place, rather than simply absorbing it into an undifferentiated shared platform. Next time you see a Scania or a MAN truck pull up next to you on the highway, you will know there is a genuinely fascinating corporate history behind that badge, one involving quiet share accumulation, a failed hostile takeover, a complicated cross-shareholding situation between two truck makers with the same emerging parent, and more than a decade of patient strategic positioning that finally brought one of the most respected names in heavy trucking fully under German industrial ownership without erasing what made it Swedish in the first place. What surprised you most about how this ownership structure actually works? Drop it in the comments below. We genuinely want to know. Thanks for watching Titan Haulers, and remember to subscribe for much more.